In this video, I'll break down the difference between saving and investing, and I'll actually give you some key strategies of each you can apply on your own. Okay, before I jump into the difference between the two, I do have to talk about two different key strategies. You have wealth building mode and you have wealth protection mode. Here's the difference. So wealth building mode is when you are still working and you have a timeline to achieve financial independence or retirement, and it could be 5, 10, 15, 20 years out or more. In that case, again, you are in wealth building mode. Wealth protection is different. That's when you're very near to financial independence or retirement, or maybe you sold a business, sold some real estate, or inherited capital from a loved one that recently passed away. In that case, you are most definitely in wealth protection mode. Okay, knowing the difference between the two, let's drill into saving versus investing. So savings is only for wealth protection mode, but with some limitations, and I'll get to that in a second. So a savings account, for context, will usually get you a return, annual return, between 0.01 and 1% per year. If a bank says they can give you a savings account that's more than 1%, I'd be asking questions. It's very rare, but it's typically a very low percentage. And for context there, a savings account does not keep up with inflation. In other words, a savings account will actually make you poor over time. So let me explain. So inflation should typically be between 2% and 3% per year. Well, the last few years, it was not that. It was much higher. So 2021, it went as high as 7%. 2022, it went as high as 9%. 2023, it started at upper sixes and eventually went down to lower threes, which is great. Now 2024, we're sitting at lower threes, which we're on the right track. We're not between that 2 and 3% where we want to be, but we're pretty close. But as you can see, inflation is outpacing your savings account, which is why you don't want too much money sitting in it. So the number one strategy for a savings account is an emergency fund. Emergency fund should typically be between 3 and 6 months salary. Just in case something happens in your life, you can immediately go to your emergency fund and take care of it. So a few examples would be, let's say something happened to your home, you have to make home repairs. Let's say your car broke down, you have to get another car. I recommend a newer used car. Don't go brand new. The reason is you buy a new car and drive it off the lot, typically depreciates about 15%, maybe even a little more. So you don't want to do that. Another surprise expense would be medical bills. Nobody likes that. So you want that savings set aside for items like that. And what I also do is I keep one savings account. If I want to use savings for something like treating myself to a vacation, I will use that. But typically best practice, if you deplete that savings account less than 3 months, try to get it bumped back up. Try to focus on your income to get that amount back up between 3 and 6 months. Now the question is, should you have more than 3 to 6 months in your savings account? My answer to that is probably not, unless you're really saving up for something big. It could be, let's say you want to buy a larger house, or if you do want to buy a newer car, maybe you want to start a business, then I get it. Then you could have more than 6 months, but in most cases, I usually don't recommend it because it's not keeping up with inflation. It's not building your wealth. Okay, with that in mind, let's move on to investing. So investing can actually be used for wealth building mode and wealth protection mode. So let me explain. Wealth building mode, you should be in individual stocks, strong value stocks. At Tykr, we are highly focused on buying those individual stocks. We want to aim for returns that are usually between 15 and 50% per year. The market average is usually 6 to 8%. As you can see, getting those bigger returns will help you not only match the market, but beat the market. You want money working for you. Let me really emphasize that. It's important for all of us to be working and providing value to others by selling products or services. We can either do it through an employer or we can become an entrepreneur. In other words, we are trading our time for a paycheck in some way, shape, or form, but you really want to learn how to flip that equation and get money working for you. And that's why investing is one of the most important strategies with money management, and it can be actually one of the easiest. It's pretty low barrier to entry these days. Anyway, all right. So diving into investing, you have wealth building mode, wealth protection mode. I mentioned that wealth building mode is individual stocks. Wealth protection mode, that's when you should be in funds, in index funds, an ETF, or mutual fund. Essentially, at the end of the day, they're a bundle of stocks. They can be between 100 and 1,000, somewhere in between sometimes. Sometimes they have bonds kind of mixed in there as well. Don't worry about that. But essentially, the purpose of a fund is to match the market. If it's a little better or a little worse, don't split hairs on that. Don't worry about it. The objective, again, is wealth protection mode. So again, if you're somebody that's nearing financial independence or retirement, you can go ahead, focus more on those funds, index funds, ETFs, and mutual funds. Going back to wealth building mode with investing, that's when you're investing in those individual stocks. Again, we're highly focused at Tykr in getting those returns between 15 and 50% per year. Okay, to zoom out and kind of recap, savings account, wealth protection mode, emergency fund, 3 to 6 months salary. That's the focus. That's the strategy. That's what you want to use a savings account for. Investing, you have the two strategies, wealth building mode or wealth protection mode. You can be highly focused on individual stocks if you're in wealth building mode, or you can move to those funds, index funds, ETFs, and mutual funds if you're more in wealth protection mode. I hope this video helped you out with knowing the difference between saving and investing. If you like this video, hit that like button. If you want to see more videos like it, hit that subscribe button. And if you want to learn how to invest on your own with confidence, especially finding those individual stocks, I invite you to join Tykr for free.